Hello friends, welcome back to JK Shah classes. I am Professor Nihit Jhaveri. Today we will be revising penalties chapter for CA final direct tax and international taxation for AY 2025-26. That is May 25 and November 25 time. There are 31 penalties given in Income Tax Act. Out of 31 penalties, most of the penalties we are already done with in other chapters while discussing like assessment procedure chapter, transfer pricing, miscellaneous provision, etc. This chapter is supposed to be viewed at the end. However, in case you are doing it in between, no issues, you should be able to recollect. The very important penalty is section 270A, which is the lengthiest and the time consuming, and most importantly, questions in the exam come on this section only for 5 marks to 6 marks practical questions. This is the penalty for under-reporting of income. Under-reporting means concealment of income. Earlier, it was penalty under section 271 subsection 1 clause C, which was concealment penalty. But concealment means purposely done, deliberately done, done with the knowledge of what assessee is doing. In one of the cases of Reliance Petro Products, there was a Supreme Court decision in the earlier penalty that if it is done unknowingly, then penalty cannot be levied. Because of that, this section was deleted, replaced by 270A with a different title. Instead of concealment of income, now the penalty is for underreporting of income. So even if done unintentionally, then also penalty can be levied. There are two slabs. This section has got 10 subsection, 270A subsection 1 till subsection 10. Subsection 1 talks about the powers of JCIT to levy this penalty. Subsection 7 and 8 talk about the quantum of penalty. Subsection 7 says that penalty for underreporting of income will be 50% of the tax payable. Tax payable would mean tax plus surcharge plus health and education cess. The basic tax plus surcharge plus health and education cess. However, that was 270A subsection 7. But subsection 8 says that in case if done intentionally with the wrong intention, then the penalty will be 200% of the tax payable instead of 50%. 270A subsection 8 says that penalty will be 200% in case if the underreporting is because of misreporting, or you in technical language you can say underreporting is in consequence of misreporting. Tax payable, remember it's 50% or 200% of the tax payable, and tax payable would mean surcharge plus health and education cess inclusive of everything, not interest, only surcharge and health and education cess. Now when can we say that there is misreporting of income or underreporting due to misreporting? That is given in 270A subsection 9. 270A subsection 9, 6 possibilities where we can say that there is a misreporting of income, and here if there is a misreporting, penalty will be 200% of tax payable, plus assessee will not be entitled to relief or immunity given in section 270AA, which we will be discussing in some time. 6 possibilities of underreporting due to misreporting: misrepresentation or suppression of facts. Misrepresentation or suppression of fact. Certain items in the P&L account balance sheet are wrongly represented. There is a misrepresentation. Say for example, assessee has only one peon. Then instead of claiming salary of one peon, in his books of accounts P&L he claims salary of 3 peons. That is called misrepresentation of the fact. Assessee has 50 lakh rupees of income, but he discloses income of only 30 lakhs. That is called suppression of facts. So there is a suppression of facts or misrepresentation of fact. Next 3 points B, C, D are in the form of 3 items not disclosed or not recorded in the books of account. First point is misrepresentation of facts or suppression of facts. Then next 3 items are not recorded in the books of account. Which 3 items not recorded? Number 1, investment not recorded in the books of accounts. Next, any receipt which has got any kind of bearing on the computation of total income. Any receipt which has got any bearing on the computation of total income, that receipt is not disclosed. And number 3, international transaction or deemed international transaction or a specified domestic transaction is not disclosed in the IT, not in the IT return, not disclosed or not recorded in books of account. Failure to record in the books of accounts investment, any receipt having bearing on the total income, any international, deemed international or a specified domestic transaction. Next item is in case recorded in the books of account but a false entry is passed. Recording any false entry in the books of account. And last one, bit off the track, claim of expenditure by assessee which is not supported by any concrete evidence. Claim of expenditure which is not substantiated by any evidence, not justified by any evidence. Then in such situation, AO can not only disallow that expenditure, charge tax also, plus penalty will be 200% of tax payable. When can we say that there is underreporting of income? Underreporting of income has got 3 plus 1 4 possibilities, and the first 3 possibilities are reproduced in the form of deemed income. First 3 possibilities are income, 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 and next 3 possibilities are deemed income, deemed income, deemed income. What is deemed income? Deemed income in connection with minimum alternate tax MAT or alternate minimum tax AMT, whereby deemed income would mean from book profit perspective, deemed income would mean book profit, and from AMT purpose, AMT chapter perspective, deemed income would mean adjusted total income ATI. So first 3 possibilities, understand very clearly. Income as per section 143.3, income assessed income under 143.3 is found to be greater than the income as per 143.1. Income under 143.1 means summary assessment or the intimation, you can call it as. Or next possibility is income or the deemed income as per 147, that is reassessment, is found to be greater than the income assessed under previous proceeding. Income as per latest proceeding assessed reassessed under 147 is found to be greater than the income as per preceding proceeding under 143.3 or 144 or 147. And the next possibility is IT return is not filed. If IT return is not filed, then assessee has not disclosed anything. Then if the income assessed, when will we or under which section income will be assessed if IT return is not filed? If IT return is not filed, friends, then income would be assessed under section 144, best judgment assessment. Then in such situation, income assessed under 144 or 147 is found to be greater than basic exemption limit if IT return was not filed. These are the 3 fundamental possibilities. Same 3 possibilities are repeated with regards to deemed income, that is book profit or adjusted total income. If deemed profit or deemed income under 143.3 is found to be greater than deemed income under 143.1. Next is deemed income under 147 is found to be greater than deemed income under 147 or 143.3. And third, IT return is not filed and the deemed total income is found to be greater than basic exemption. Last possibility, if income assessed or reassessed has the effect of reducing the loss or converting loss into income. Reducing the loss or converting loss into income, 2 examples I will give you. Example A, example B. If the IT return was filed or maybe 143.1 was done with negative income 6 lakhs, loss of 6 lakh rupees, and now under section 143.3 or under 144 or 147 as the case may be, assessment takes place on an income of 5 lakh rupees. Addition made is 5 lakh rupees, and second example addition made is 10 lakh rupees. So what happens is, in the first example, loss from 6 lakhs becomes 1 lakh. This has the, so that means assessment has the effect of reducing the loss. And second possibility, negative 6 lakhs will get converted into positive income of 4 lakh rupees. Second example is the example of negative income or loss getting converted into a positive income. In both these situations, assessee will be deemed to have underreported income. Now we are not discussing misreporting, we are discussing underreporting. Underreporting in 3 plus next 3 and plus last with regards to loss, total 7 possibilities. So in a shortcut way, I will tell you, please understand that in case if IT return was filed, remember this is important, IT return was filed disclosing income of 5 lakh rupees, and thereafter 143.1 takes place. In 143.1, AO makes addition of 1 lakh rupees. How much addition he makes? 1 lakh rupees. This 1 lakh will not be regarded as underreporting of income. However, 143.1, thereafter 143.3 takes place by chance, and income determined is 9 lakh rupees, or assessment is done on an income of 9 lakh rupees. Then further addition made by 3 lakh rupees. So technically AO has made addition of 4 lakh rupees, but entire 4 lakh will not be deemed to be underreported income. Only 3 lakh will be deemed to be underreported income. Tax on this 3 lakh will have to be computed, plus surcharge plus health and education cess. Then 50% of that tax payable or 200% of that tax payable will be penalty. Supposingly later on same case 147 also takes place, and the income reassessed or assessed under 147 is 15 lakh rupees. That means addition of 6 lakh rupees under 147. This 6 lakhs will also be considered as underreported income. However, only thing to be remembered is this 1 lakh rupee added by AO under 143.1 will not be regarded as underreported income. right? So you can just take a screenshot of this page if you want to. Okay, now proceeding further. Okay, then 270A subsection 6. So out of all these things, the quantum of penalty is important. How much will be the penalty? That is the most important part. You will be having practical question. So what do you mean by underreported income? That is also important. Here you need to remember from a negative aspect point of view that this particular 1 lakh added under 143(1) will not be regarded as underreported income. Rest all will be regarded as underreported income. So here we discussed it at 3 different stages: stage 1, stage 2 and stage 3, if you can understand. Only stage 2 and 3 will be regarded as underreporting of income. Thereafter 270A subsection 9, misreporting, underreporting due to misreporting, that is also important. However, you don't need to memorize this list. Simply remember in one line, whenever it is found that associate has done it intentionally with a mala fide intention, with an intention of evading tax and is caught, then it will be considered as a case of underreporting due to misreporting, and accordingly penalty will be 200% of the tax payable plus benefit of immunity under 270AA will not be available, which we are about to discuss. Now 6 exception, this also you need to remember. 5 exceptions which I have converted into 4 points A, B, C, D. There are actually 5 exceptions, but 2 of them are similar to each other, so I have merged them. So as per summary notes, there are 4 exceptions whereby penalty will not be levied only. Penalty will not be levied. Ideally, penalty will not be levied in case where associate neither 50% nor 200%, nothing would be levied. It will not be considered as a case of underreporting of income. In case if associate has provided satisfactory explanation, associate's explanation is found satisfactory to the income tax authorities, that is found satisfactory to AO or to CIT appeal, then penalty will not be levied. In case where the addition made by AO is in conformity with the, this is bit off the track, additions made by AO is in conformity with the ALP determined by transfer pricing officer TPO under section 92 CA. So if you recollect transfer pricing chapter, assessing officer himself can also determine ALP and he can make a reference to TPO whereby TPO can also determine ALP. If TPO determines ALP, transfer pricing officer, then that order of TPO is mandatory for AO to follow, if you recollect. In such situation, understand very clearly, if additions are made by AO by computing ALP on his own, if he himself calculates ALP, determines ALP, then penalty will be leviable. But in case if the same ALP is determined by TPO and that is how AO makes additions, then it will not be considered as a case of underreporting of income. Amount of addition made by AO in conformity with the ALP determined by TPO, provided associate declared all the international transaction, then penalty will not be levied. However, this benefit is not available if the addition is made by AO himself without referring to TPO. Such addition made by AO himself will be considered as underreported income. This is very illogical, but this is the fact. Keep it in your mind. I have some practical experience also of this. So just keep it in your mind, howsoever illogical may it be. If additions are made by AO by determining ALP suo moto, then penalty will be levied. It will be considered as underreporting. But if the same ALP is determined by TPO and that is how AO makes addition, then no penalty. Next is amount of undisclosed income is referred to in section 271 AAB. This is basically to avoid double penalty. Out of 271 AAB is applicable whenever there is a search conducted. So out of 7 years which are covered by search, that is current year of search plus 6 preceding year, out of 7 years 271 AAB, if you recollect, is leviable for 7th year, light penalty for 7th year, that is a year of search, plus maybe this section penalty may be levied under 271 AAB for 6th year. 6th year either penalty will be under 270A or under 271 AAB depending upon the date of search. If penalty is under 271 AAB wherever applicable, for 7th year definitely 271 AAB, for 6th year it may be or may not be. But wherever 271 AAB will apply, 270A will not apply, no double penalty. That is the idea. And last point, which is merger of 2 points, it says whenever additions made by AO are based on estimate, based on an estimate subject to certain conditions, underreported income is based on estimate. If AO makes estimation means without any concrete evidence, or AO randomly disallows something, which are also popularly called as intangible additions, then penalty will not be levied. Because AO has not been able to prove anything. For example, assessee files IT return showing income of 20 lakh rupees and he claims expenditure on taxi charges 14 lakh rupees, which is 70% of his income, and discloses net income of 6 lakhs. In such situation, AO will question him about the evidence for this taxi charges. Assessee unable to prove, AO makes some disallowance. AO says 14 lakhs is too much. Without evidence, I will allow you 3 lakh rupees. Pay tax on 17 lakh. That means AO makes addition of 11 lakh rupees. In such situation, this 11 is intangible addition. AO has not been able to prove that assessee has not spent 14 lakhs. Assessee is also not able to prove that he has spent 14 lakh, but AO is also not able to prove, and accordingly AO can charge penalty, but then AO can charge penalty, but ideally penalty will not be levied. However, this point says that penalty will not be levied, it will not be considered as underreported income, which is something very strange, and it contradicts with the earlier section of penalty, that is section 271 subsection 1 clause C, which is deleted now. I talked about it earlier also at the beginning. So this section 270A is a replacement of 271 subsection 1 clause C. Okay, these exceptions you don't need to memorize actually, though they are important. You just need to remember, you just need to keep them in your mind, that in certain situation penalty not leviable. Ideally the first two situation where assessee's explanation is found satisfactory to the department, or in case where AO has made addition based on order of TPO determining ALP. 278 subsection 4 and subsection 5, this is slightly important for theory question, practical question cannot be asked. Intangible addition. Intangible addition we just discussed, that is additions made by AO based on estimate. Such additions are called intangible additions because there is no supporting available with the AO. AO has made addition. What is intangible? Intangible means something which is there but which cannot be seen. Goodwill, copyright, trademark, which cannot be seen but it is there in this world. Something which exists but does not exist, that kind of a thing. So intangible additions are those additions which are primarily made by AO without any concrete evidence. If any intangible additions were made in an earlier year, let me explain it to you with the help of an example. So supposingly for AY 21-22, assessee files IT return showing gross income of 10 lakh rupees and claiming expenses of 8 lakh rupees. Net income 2 lakh rupees. AO disallows this expenditure. AO does the same example which I gave you for taxi charges 14 lakhs. Similarly here also assessee claims some expenditure which AO disallowed. AO says 8 lakhs is too much, I will allow you only 3 lakh rupees of expenditure, pay tax on 7 lakh. How much addition AO has made? That means AO has made addition of 5 lakh rupees. This is the story of AY 21-22 earlier year. So now in the current year AY 25-26, while doing assessment of AY 25-26, as per all previous records, assessee's capital account, balance sheet, P&L account, cash account, bank account combined together, assessee should be having reports of 107 lakhs. Assessee should be having 107 lakhs in his pocket in the form of bank balance, cash balance, all his investment at cost, everything combined together. Whatever assessee earned in so many years minus his office expenditure, personal expenditure, everything after adjusting, he should be having 107 lakh rupees as per his balance sheet, or he should have a record of 107 lakh. But assessee is caught red-handed. He is found to be having invested, received or deposited 112 lakhs. There is a difference of 5 lakh rupees as per books of accounts. I would not add 5 lakh rupees. I would say it is a difference of 5 lakh rupees. So now assessee would be questioned that where has this 5 lakhs come from? As per your books of accounts, you should be having 107, but physically you are having 112 in the form of bank balance, cash balance, investment at cost, everything combined together. If assessee does not offer any satisfactory explanation, then on this 5 lakh rupee, tax will also be charged plus penalty will also be charged. So what assessee will do? Assessee, he is caught red-handed. He has no opportunity to escape. There is no escape window available. So what to do? Assessee would ideally admit the concealment for earlier year that okay sir, this 5 lakh rupees is nothing but 5 lakhs of addition which was made in that earlier year. Addition of 5 lakh rupee which was made in that earlier year, it is same 5 lakh rupees. What is the advantage to assessee? Penalty will, if assessee himself admits that 5 lakh rupee in AY 21-22 was concealed or was underreported, advantage to assessee is that on this 5 lakh rupee in that year, tax was already levied by making addition, but penalty was not levied because it was intangible addition at that time. And now intangible addition gets converted into underreporting of income or concealment of income. Now it gets established, it gets proved. If assessee himself admits that 5 lakh of this year, difference of 5 lakh is nothing but addition of 5 lakhs in the earlier year, then concealment gets established. Penalty will now be levied. Penalty is definitely going to be levied. If assessee admits something like this, then he can at least save himself from the tax. Tax will not be levied because tax was already levied at that time without penalty. Tax was already levied, no? Therefore, now assessee can save himself. If he does not make such statement that this 5 lakh is of that year's 5 lakhs, then he will be charged with the tax also and penalty also. There will be double penetration. So, rather he should admit that. It is advisable. So, in such situation, assessee claims that difference of 5 lakhs is out of intangible additions of that year, then concealment gets established, penalty will be now levied. However, if such intangible additions pertain to more than 1 year, then what to do? Supposingly, total additions made in the earlier year were 14 lakhs, 14 lakh rupees. Acha, before we proceed further, just a small thing. In this example, the penalty will be particular percentage, penalty is particular percentage of tax. So, is it necessary for us to find out that this 5 lakh is coming from which year? Is it coming from AY 21-22 or some earlier year or the later year? Answer yes, it is very imperative for us to find it out. Reason being very simple, penalty depends upon the amount of tax payable, and tax payable can change or can differ from year to year. Therefore, it is very imperative for us to find out which year is the income pertaining to. If income pertains to, let's say, AY 10-11, then in AY 10-11 the tax rates were different than the tax rates in AY 21-22. So, it is very important. So, here penalty will now be levied in AY 25-26, but tax will be computed as per the provisions of AY 21-22 or as per the tax rates of AY 21-22 earlier year. Okay. If such intangible additions pertain to more than one assessment year, then what to do? Then answer again we will be facing this difficulty. If it pertains to more than one assessment year, we will have to find out as to how much addition pertain to which year. Supposingly that is found out. Why? Because we want to find out what tax to be applied, what tax rate to be applied, how much will be the tax for each year. In order to do that, we will have to bifurcate the additions of the earlier year into year wise. That can be found out easily. However, more than one assessment year, then what to do, to which year to be applied. For example, intangible additions were 14 lakh, but now there is a difference of 11 lakh rupee arising, for which assessee admits that this 11 lakh of addition is for earlier years. 11 lakh rupees of difference in the current year, AY 25-26, is coming from earlier years intangible addition. But the question is which year? So, answer in such situation, if we apply FIFO method, first in first out, then out of 14 lakh, for which of the year 11 lakh is coming from, then 2 lakh will be coming from AY 18-19, 3 lakh coming from AY 19-20, 4 lakhs coming from AY 20-21 and 2 lakh only coming from AY 21-22. Total is 11 lakh. However, if we apply LIFO method, last in first out, so we will start with the last year, AY 21-22, entire 5 lakh coming from AY 21-22, entire 4 lakh coming from AY 20-21, entire 3 lakh, no, only 2 lakh coming from AY 21-22 and nothing coming from AY 18-19. That is our total 11 lakh. Which method to be followed? It's been clarified that LIFO method to be followed. This particular thing, LIFO method is to be followed, last in first out. Okay, remember this can come in the form of an objective question, MCQ. Okay, then 270A subsection 6 which we are done with. So, 270A subsection 5 also you will have to remember, whenever a theory question comes, you will have to reproduce both the subsections, subsection 4 and subsection 5. Now, 270A 270AA, immunity from penalty. It says that this particular penalty, normally what happens is, assessment is completed, then AO starts penalty proceeding, AO will issue show cause notice for penalty, SCN, and then AO will pass separate penalty order. If AO levies penalty, one can go for appeal or one can apply to CIT for revision under section 264, or under this chapter one can approach CIT under section 273A subsection 1 or subsection 4 for granting immunity. One can approach CIT PCIT, or one can go to CIT appeal for filing appeal under section 246 or JCIT appeal, 246A, sorry, 246 is JCIT appeal and 246A is CIT appeal, or assessee can approach CIT PCIT under section 264 for revision. Three remedies are generally available, but these three remedies take place only after AO passes the penalty order. But is there any remedy available right now after assessing officer passes the assessment order, making addition and charging tax, but before AO passes the penalty order? In between, if there is a time gap, assessee can avail remedy under 270AA by fulfilling three conditions. Which are the three conditions? These three conditions you have to remember, slightly important. Question hasn't come up till now, but if a question comes, it will be a theory question. Three conditions to be fulfilled by assessee. Number one, assessee pays tax plus interest. Pays tax plus interest if any, but not penalty. Penalty, payment of penalty we are not commenting upon. Penalty will be waived off by AO. If assessee fulfills three conditions, AO will not charge penalty. Number one, he pays tax plus interest within the time limit given in demand notice under section 156, plus he files no appeal against the original assessment order. No appeal. Whatever additions are made by AO, assessee admits it that okay, addition I am fine with, disallow me this much, I am ready to pay tax also plus interest also, but penalty assessee will have to apply without filing appeal against the assessment order, without challenging AO, and assessee makes an application to AO under section 270AA in form number 68. Form number need not be remembered by you, just remember prescribed form. Three conditions are fulfilled, and actually there is one more condition. It is not a case of 270A subsection 9, that is misreporting, penalty due to underreporting due to misreporting of income. If there is a misreporting of income, then penalty also will be levied. AO will not grant any immunity, plus penalty will be 200% of tax payable. And tax payable means tax plus surcharge plus health and education cess. Okay, so technically though they say three conditions, there are four conditions. There is a time limit to make this application. Application is to be made within 1 month from the end of the month in which assessee received the copy of assessment order for which he is not filing appeal. So what are the three conditions? Assessee pays tax plus interest as per assessment reassessment order within the time allowed in a demand notice, does not file appeal against the original assessment order, and he makes an application to AO within 1 month from the end of the month in which he received copy of assessment reassessment order, but provided it is not a case covered by section 270A subsection 9. If it is covered by 270A subsection 9 misreporting of income, then penalty will certainly be levied, plus there will be penalty of 200% of tax payable. With that, 270A is over. Up till now 3 questions have come in the exam, plus there are equal number of questions in MCQ digest. Nowadays questions come for 2 marks in the form of MCQ, but which require you to solve the entire question. Remember, if penalty is given to you at 3 different stages or 2 different stages, then calculate penalty individually. Question will clarify whether the case is covered by 270A subsection 9 or not. Then you will understand whether this is applicable or not. 200% penalty is applicable or 50%, that institute will give you a hint in the question which you have to understand. With that, 270A and 270AA is over, very important from exam perspective. Upcoming penalties, out of total 31 penalties, we are done with 1 penalty. Next is 271A. 271A is for failure to maintain books of accounts documents as required under section 44AA. 44AA is a part of PGBP chapter. There we had discussed this penalty, 25,000 rupees of flat penalty leviable if books of accounts documents are not maintained. P&L account, balance sheet, capital account. How many years of books of accounts are to be maintained? Answer: 6 years from the end of the relevant assessment year, 7 years from the end of the previous year. 271AA subsection 1 and subsection 2, these two are in connection with transfer pricing chapter, which we have already done with in transfer pricing. 271A also we are done with, and AA subsection 1, AA subsection 2 are also done with. Both are in connection with transfer pricing. 271AA subsection 1 says that as per rule 10D read with section 92D, every person who has entered into international transaction or deemed international transaction or a specified domestic transaction is required to maintain certain data, document, information for a period of 8 years from the end of the relevant assessment year. That means 9 years from the end of previous year. If not maintained, then this penalty will be levied. Penalty will be equal to 2% of the value of international transaction, deemed international transaction or specified domestic transaction for which data document information not maintained. That was 271 AA subsection 1, which we discussed in miscellaneous provision chapter also, and we discussed in transfer pricing chapter also. This is the third time we are discussing. Similarly, 271 AA subsection 2, this is for master file, local file. This is 271 AA subsection 1, data document information not maintained. 271 AA subsection 2 says that 92D4 or 92D subsection 1 clause 2 requires assessee to furnish master file, local file. Time limit to furnish master file, local file is on or before the due date of filing IT return, that is 30th November of the assessment year. In that case, if not furnished in form number 3 CEAA, form number not to be remembered, part A and part B, part A is master file and part B is local file. If these are not furnished in connection with international transaction, then assessee will be levied with a penalty flat 5 lakh rupees. 5 lakh rupee. Here for normal data document information, penalty will be in terms of percentage of the value of transaction, 2%. But here for master file, local file, there is a flat penalty of 5 lakh rupees, on which questions have never come till now. Question is likely to be asked anytime. 271 AAB. 271 AAB shall no more apply with regards to search initiated on or after 1st September 2024. Search is initiated on or after 1st September 2024, then 271 AAB shall no more apply. Otherwise also it has become redundant. It became redundant during demonetization of high value currency notes of 500 rupees and 1000 rupee. Since then only, 2016 only, it had become redundant, but still it is applicable, not officially deleted from the act. It says that whenever a search is conducted, you know pretty well, 6 years are covered. Past 6 years, 1, 2, 3, 4, 5, 6, 6 years preceding the year of search, and 7th year is a year of search. So what happens is, whenever IT officers come for the search, we know pretty well, whenever IT officers come for the search and huge amount of cash or undisclosed income is found, it will be divided or apportioned among 7 years. However, what happens is, for the incomes pertaining to first 5 years out of a package of 7 years, assessee has no remedy. Assessee claims, suppose any undisclosed income works out to be 5 crore rupees for these 5 years. For here, penalty will certainly be levied, and that too under section 270A. It is clearly a case of underreporting due to misreporting. 200% penalty will be levied. But as far as the year of search is concerned, see, undisclosed income pertaining to this year is 1 crore, and 7th year also, year of search also is 1 crore. For these two, 1 crore, assessee would always be in a position to argue that, sir, I was just going to file IT return, especially for 7th year, year of search, which has not yet ended. Say date of search is 18 July 2024, year has not ended, and assessing officers come for the search. Assessee can always say, sir, the year will end on 31st March 25, I will pay tax on this income and I was going to file IT return, I was going to include this income in the IT return. Then department would be in a puzzling situation. Assessee argues that this 1 crore is not reflecting undisclosed income, I was going to disclose it. Same story for 6th year also. As on the date of search, now 6th year's IT return filing due date will fall due in the 7th year. As on the date of search, IT return due date for 6th year has not yet expired. IT return due date would expire on 31st July 24 or maybe 31st October 24, and the search is conducted before that. Search is conducted on 18 July. So assessee for 6th year also could argue that, sir, this 1 crore rupees, I was just going to file IT return in the last 13 days, 18 July plus 13 days, 31st July. I was going to disclose it in IT return, I was going to pay self-assessment tax, but you people turned up and you are treating it as undisclosed income, charging me heavy penalty under 270A. So don't do that, don't charge penalty, it is not undisclosed income. In such situation, AO would be in a puzzling situation. So what provisions have been incorporated? Provisions are made that for year 7 for sure, here, and for year 6 also, 270A subsection 7, 8 will not be levied, heavy penalty will not be levied, but penalty will be a little light penalty under 271 AAB, which will depend upon, quantum of penalty will depend upon two types of conditions. If both the conditions are satisfied, then the penalty was 10% of income, undisclosed income, light penalty. As compared to 200% of tax, penalty would be 10% of income, and if some conditions are satisfied and some conditions are not satisfied, penalty would be 20% of undisclosed income. 10% and 20% of income. However, during demonetization in November 2016, government came across some situations where people were taking undue advantage and ended up paying penalty of just 10%, which was very unfair to those people who voluntarily disclose entire income before demonetization. So government came out with a new concept from 15 December 16, that is, the search is initiated on or after 15 December 2016, then the penalty will not be 10% and 20% of income. Penalty would be 30% or 60% of the income, undisclosed income, depending upon fulfillment of certain conditions. All conditions are satisfied, then penalty will be 30% of income, otherwise penalty will be double than the income. 30% of income can be understood as 100% of tax, and 60% of income can be understood as double of tax. So light penalty has no more remained light as compared to 10%, 20% earlier. Now it has become 30%, 60% with effect from 15 December 16. So this entire 271 AAB makes no sense. And now if search is initiated on or after 1st September 2024, then no penalty under 270A, no penalty under section 271 AAB for 6th year or 7th year. Penalty will be under section 158 BFA subsection 2, which will be 50% of income, 50% of undisclosed income unearthed as a result of search. Okay, this penalty will be leviable under block assessment concept. Okay, so 271 AAB, what are the conditions? So 10% has become 30% and 20% of undisclosed income has become 60%. So this light penalty concept is given a go away, penalty will be heavy only. 60% of income is as good as 200% of tax, assuming 30% average tax rate, penalty becomes twice the tax. Okay, if assessee first condition has two sub conditions and second condition also has two sub conditions. So in total there are four conditions, one by one. First condition says if assessee admits concealment, when the search is concluded, upon conclusion of search, a statement is recorded under section 132 subsection 4, which is called Panchnama also. During that Panchnama, assessee admits concealment, that yes, I have done something wrong. He voluntarily admits, plus he pays tax plus files IT return within certain time limit. Then penalty will be 10%, now 30% of undisclosed income. If he does not admit concealment but he pays tax plus files IT return, then penalty will be double, 20 or 60% of the undisclosed income. Or in any other case, if any of these conditions, none of the conditions are satisfied, penalty will be 60% of undisclosed income. You following this? However, this section has become redundant, so I am not expecting any question on 271 AAB in the exam for sure. Then there is a meaning of undisclosed income clarified, that undisclosed income would mean income of the specified previous year. Specified previous years means any of these 7 years. Specified previous year would mean any of the 7 years for which either IT return is not filed or IT return is filed, but this income is not disclosed or it is not recorded in the books of accounts. If IT return is not filed, then it will be called as undisclosed income, provided it is represented by money, bullion, jewelry, valuable article or thing, or any entry in the books of accounts documents which is either not recorded or recorded but found to be false. Then it is undisclosed income of specified previous year. 271 AAC, this is in connection with 60% tax rate under 115 BBE. Any person who files IT return and in his IT return he has included income covered by section 68 unexplained cash credit, 69 unexplained money, bullion, jewelry, 69A unexplained investments, 69B money, bullion, jewelry or investments not fully disclosed, or section 69C unexplained cash expenditure, and 69D repayment or borrowing on hundi, that is bills of exchange, otherwise by way of account payee check. Then he will be that much amount will be added, amount in default will be added to the income, plus as per 115 BBE there is a flat tax rate of 60% plus 25% surcharge compulsory irrespective of income, plus 4% health and education cess. Effective rate will be 78%. 78%, but here penalty will be 10% of 60%, 10% of basic tax rate, penalty will be 6% of the income, provided assessee is covered by this particular these sections to section 68, 69, 69 A, B, C, D, and he has filed IT return. In IT return he has included such income. If tax is not paid, tax on such income is not paid by the end of the relevant previous year, then only this penalty will be levied. 271 AAD. Okay, 271 AAD was recently introduced from AY 21-22 onwards, 3-4 years back. It says that if assessee makes any false statement or passes false entry or omits to pass correct entry, either wrong entry is passed or correct entry is omitted, correct entry is not passed, then in such situation with an intention to evade tax liability, then penalty on any other person who causes the assessee to make such false entry or omit any entry, this penalty can be on assessee as well as his accountant. Penalty will be an amount equal to amount for which false entry is passed or the correct entry is not passed. The next is section 271 AAE. 271 AAE was introduced in AY 2023-24. It says that certain institution associations, fund, university, educational institution, hospital, medical institution, which are referred to in section 1023C, that is approved under section 1023C subclause 4, 5, 6, 6A, or a trust which is registered under section 12AB claiming exemption under section 11, either claiming exemption under 1023C or claiming exemption under section 11. Whenever they receive donation, they are supposed to do two things. Number one, these trusts etc., whenever they receive donation, they are supposed to furnish one statement with the income tax authority giving details of donations received by them all throughout the year, and plus they are supposed to issue a receipt cum certificate to the donor. Form number 10 BD to income tax department, form number 10 BE to donor. Okay, trust will have to issue one statement, annual statement to income tax department that how much donation they received, and 10 BE will be a certificate of receipt to be issued by trust to the donor that this much donation is received. Either of them is not done, then there is a penalty of minimum 10,000 rupees, maximum 1 lakh rupees. Clear about this? Okay. So, however, here we are not talking about that statement will come later, 271K I think. Here we are talking about, if you recollect, specially charitable trust chapter. In trust chapter there was somebody called specified person. Specified person would mean author, founder, manager, trustee of the trust. Any substantial contributor means person who has contributed more than 50,000 by the end of the previous year. From inception of the trust till the end of the previous year, somebody who has contributed more than 50,000, or any relative of the above mentioned persons. These people are called specified persons. I repeat the names. Charitable trust chapter we are done with this section. Author of the trust, founder of the trust, manager of the trust, trustee of the trust, any substantial contributor, or any relative of any of the above mentioned persons, including HUF of above mentioned person, HUF, or any concern in which these people have, author, founder, manager, etc., have substantial interest. Then trust passing on or using its income directly, indirectly for the benefit of specified persons covered by section 13(1), then in such situation, that much part of the income which is so utilized for the benefit of these persons, provided it exceeds 1000 rupee per annum, the amount utilized for the benefit of the specified person will be deemed to be the income. And this penalty can be charged. How much penalty? If caught red-handed for the first time, penalty will be equal to 100%. First time, it will be 100% of the aggregate amount of income which is utilized for the benefit of these people. And if caught for the second time or subsequent time, then penalty will be 200% of the aggregate amount of income which is applied towards benefit of these people. 271B is my favorite section, failure to get books of accounts audited. This penalty all of us should be knowing, because this is what we are going to do. tax audit report as required under 44AB, form number 3 CA CBCD. Penalty will be 0.5% of sales, gross receipt or turnover, or number 2, penalty will be 1.5 lakh flat, whichever is lower, whichever is less. Okay, this penalty is slightly important, keep it in your mind. 271BA, failure to furnish report of chartered accountant as required under section 92E, that is form number 3 CEB, due date 30th November of the assessment year. CA report in form 3 CEB as mandated by section 92E is not furnished. What is the time limit to furnish? Time limit to furnish each and every report under the Income Tax Act is 1 month before the due date of filing IT return. If IT return due date is 30th November 2024, then this due date will be 30th November 24 minus 1 month, 31st October 24. Not furnished, 1 lakh rupee flat penalty is leviable. 271C and 271CA we are done with in this chapter called TDS chapter. After deducting TDS, the person is supposed to deposit TDS and file TDS statement, quarterly statement. But if he fails to deduct, failure to deduct the tax at source under any section between section 192 to 196D, that is entire chapter 17B, failure to deduct tax will attract penalty equal to the amount of tax not deducted. Or there is one more failure, or assessee fails to pay from his own pocket or ensure payment from the payee of the whole or any part of the taxes required under section 1150. 1150 is deleted from AY 23-24, that was dividend distribution tax. Assessee fails to ensure payment of 194B, that is winning from lottery in kind, if the winning is in kind, or 194R, benefit perquisite exceeding 20,000, or purchase of virtual digital asset 194S, then penalty will be equal to the tax which the payer has failed to pay or deposit to the credit of central government. Here they don't call it as depositing with central government, they say pay to central government. Interest may be charged, interest will definitely be charged, plus penalty under this section. Penalty will be equal to tax not deducted, simply penalty will be equal to amount in default. Same thing for TCS also, failure to collect the tax, failure to deduct the tax, or failure to ensure payment, or failure to collect the tax. Penalty is same, amount equal to loan deposit, sorry, not this point. Penalty will be equal to the amount of tax not so collected. 271D, DA, DB and E, 1, 2, 3, 4 we are already done with in this chapter called 269 SS, requirement as to mode of acceptance and repayment of certain loan deposit specified sum. Specified sum can be understood as specified advance also. It is nothing but advance received in connection with transfer of immovable property, whether transfer ultimately takes place or not. Taking or accepting loan deposit of specified sum in contravention of 269 SS. 269 SS, that means amount is 20,000 or more, then he will be levied with this penalty. Penalty will be equal to the amount of loan deposit of specified advance in contravention of this particular section. This section contravenes the acceptance in cash of 2 lakhs or more than 2 lakh. Up to 1,99,999 is fine. 2 lakh or more than 2 lakh is received in cash, then next penalty. 271D talks about taking or accepting loan deposit or specified sum or specified advance in violation of 269 SS. That means 20,000 or more than 20,000 is accepted as advance. Okay, 271DA, any person receiving cash of 2 lakhs or more. This is slightly important, cash of 2 lakhs or more as in contravention of 269 ST, then that person will be levied penalty. Penalty will be equal to the entire amount, of cash received in contravention of 269 ST. No benefits will be given, assessee will be liable to pay tax and interest. 271DB, 271DB is for violation of 269 SU. 216 SU says that any person whose last year's sales gross received turnover exceeded rupees 50 crore in the immediately preceding financial year, then for the current financial year he will be required to provide facility. Then such person with business turnover exceeding 50 crore last year is required to furnish facility for accepting payment by way of prescribed electronic mode, in addition to NEFT, RTGS, etc., he will have to offer facility of accepting payment by either RuPay compatible debit cards or credit cards, or he can pay, assessee can pay by way of, assessee means person who's making payment. Person who's doing business, last year's turnover exceeded 50 crore. If he does not offer facility of payment by customer, or from his perspective facility for accepting payment by way of RuPay debit card or UPI or Bheem UPI or UPI QR code, then he will be levied with a penalty of 5,000 per day of failure. However, exception here is B2B transaction. Exception is B2B transaction. Those who are into business to business transaction, they need not offer this facility to their customers because the transactions would be of a very high amount. Payments are always made by account pay check. 271FA, failure to furnish statement of financial transaction, SFT. Statement of SFT is to be furnished in form number 61A on or before 31st May of the relevant assessment year. That is, after March ending, assessee gets 2 months time, April and May, full 2 months to furnish this statement in form number 61A. If he does not furnish, or there is a default in furnishing or late furnishing, penalty will be 500 rupee per day. 500 per day. However, this 500 per day will become 1000 rupee per day if not filed, statement is still not filed, and Director of Income Tax issues a notice, DIT issues a notice giving some further time limit, and provisions are not complied with even after expiry of the time limit given by DCIT. If statement of financial transaction is not filed, then Director of Income Tax can issue notice giving assessee maximum 60 days time limit to file such statement. Still it is not furnished and the time limit given to him has expired, then penalty will be 1000 rupee per day. 500 per day or 1000 rupee per day. When will it be 1000 rupee per day? After expiry of the time limit given in the notice. We missed out this 269 ST which we are done with in that chapter. This is in connection with the same loan transaction. Loan or advance, specified advance or deposit is repaid along with interest exceeding or equal to 20,000 or more, otherwise by way of account pay check, account pay draft or electronic clearing service, then person who is repaying the loan will be penalized. Both the penalties 271D and 271DE both are in the same lines. 271D talks about acceptance of repayment, 271E talks about acceptance of or taking it, and 271E talks about reversal, in a sense repaying it back. Okay, so 271FAA with regards to this SFT, statement of financial transaction, time limit is 31st May to be furnished in form number 61A online. Offline it cannot be, online, and in case if there is a delay, then 500 rupee and 1000 rupee. But in case that statement is furnished within time limit, but there is inaccurate information, assessee, the person responsible to file SFT, has furnished it within the due date, but 31st May, but has furnished inaccurate information in a statement, or assessee, that is customer, has a customer failed to inform about the inaccuracy in such statement. So supposing this statement is to be furnished by bank is one of them. There are around 14 transactions covered here where this statement of financial transaction is required to be furnished. One of them is bank, or most of the places it is bank, credit card issuing company, company coming out with IPO of shares, company issuing rights, mutual fund issuing units, RBI issuing bonds, or company issuing debentures. Then that company, government, RBI, etc., or registrar of property, they are required to furnish the statement. If statement contains inaccurate information, penalty will be 50,000 flat. Or in case inaccuracy is already known to the officer furnishing the statement, banking officer furnishing the statement, he knows about the inaccuracy, but he fails to inform about inaccuracy to the concerned income tax authority if he knew about it. And last one, if he didn't know at the time of filing such statement, he didn't know about the inaccuracy come to his knowledge later on, then whenever it comes to his knowledge, within 10 days from the date of receiving information, he should furnish revised statement of financial transaction. If he doesn't do 50,000 flat penalty, plus last year another penalty was introduced, 50,000 will certainly be levied, plus 5,000 rupee for each such default, each such reportable account for which inaccurate information is furnished. And then this 5,000 banks etc. can recover from the reportable account holder. Okay, nothing great. I put it under category B. Okay. Now the next is section 271 FAB. Failure to furnish the statement or information or document by an eligible investment fund as required under section 9A. We are already done with the chapter. I have recorded a separate video on section 9A immediately after section 9.1, income deemed to accrue or arise in India. If you recollect, section 9A, if there is an investment fund located outside India, they appoint somebody resident in India as their fund manager. So fund manager is resident in India, investment fund is incorporated outside India. Through fund manager, investment fund makes some investments in India as well as outside India. Then certain conditions are satisfied, then certain incomes of that investment fund will not be taxable in India, provided that investment fund is an eligible investment fund. When will it be called as an eligible investment fund? If the eligible fund, if the investment fund fulfills 13 conditions and the fund manager fulfills 4 conditions. 17 conditions are fulfilled subject to some relaxation for unit located or fund manager located in IFSC, International Financial Service Center. Then fund will be eligible investment fund. But whether these conditions are satisfied or not, on a yearly basis they will have to furnish some statement. If that statement is not furnished within the time limit given, which is 90 days from the end of the financial year, then 5 lakh rupee flat penalty is levied. This penalty is unimportant, 271 FAB. Next is 271G, important penalty in connection with transfer pricing. So for transfer pricing, 271 AA subsection 1 we had discussed that if there is a failure to maintain certain data document information as given in rule 10D read with section 92D subsection 1 clause 1, certain data document information which are to be maintained for a period of 8 years from the end of the relevant assessment year, then there is a penalty to the tune of 2% of the value of such international transaction or specified domestic transaction. If not maintained, then 2% penalty. If not furnish, here maintenance. If not furnish, then penalty under section 271G. If not furnish within the time limit given by AO or CIT appeal in a notice, then this penalty is leviable, again 2% of the value of international or specified domestic transaction for which data document information is not furnished. Whenever called upon by AO or CIT appeal, then this section was amended in AY 1617 by Arun Jaitley ji, authorizing TPO also to charge penalty. Time limit to furnish such data document information was 30 days earlier. Now it is brought down to 10 days, within 10 days. Extension possible for maximum 10 more days, maximum 20 days will be given. 271 GA is a penalty in case of Hutch, Whampoa, CGP, Cayman Island and Hutch India. If you recollect, Indian concern, we had discussed it in miscellaneous provision chapter. I have recorded one separate video on all these sections where I have covered this section 285A, statement by Indian concern, statement by eligible investment fund, then statement of financial transactions. All these things I have covered in a separate chapter called miscellaneous provision. I would suggest you to have a look at that video first. You will have a better understanding. And in that video, I have covered all these penalties also. Here in a penalty chapter, these penalties are getting repeated. Okay, but still I will teach you for those who are watching this video in isolation without watching that miscellaneous provision video. So, Indian concern. So, if you recollect, Hutch Hong Kong, the same example I had been giving you again and again. Hutch Hong Kong as in Hutchison Whampoa Hong Kong, they floated one subsidiary company CGP in a country called Cayman Island, which is a tax haven country, Cayman Island. And this company created 100% subsidiary in India called Hutch Telecommunication International India Limited. I will call it as Hutch India. Okay, Hutch Hong Kong holds 100% of CGP and CGP holds 100% of Hutch India. In such situation, this entity Hutch India will be called as an Indian concern. It will be an Indian concern if conditions given in explanation 5, 6, 7 of section 911, explanation 5, 6 and 7 of section 911 are fulfilled, then this Hutch India will be called as an Indian concern in which foreign company holds assets in India. In such situation, this Indian concern Hutch India will have to submit one statement to prescribed income tax authority within some time limit. What is the time limit? I will tell you. Statement to be furnished in form number 49D. What statement? This statement is not to be furnished every year. This statement is to be furnished by Indian concern only in that year when or only for that year in which there is a transfer of shares of this company, CGP. Who will transfer? The answer: person who's owning the share. Who's owning the shares? Hutch Hong Kong is owning the share. Whenever Hutch Hong Kong transfers the shares of CGP, the Indian concern will have to inform income tax department that somebody has transferred shares of CGP, because according to explanation 567 of 911 section, some part of the capital gain arising to Hutch Hong Kong, some part of the capital gain is deemed to accrue or arise in India if some conditions are satisfied. So, how much is deemed to accrue or arise in India? Say example, 10,000 crore is a capital gain accruing to Hutch Hong Kong from transfer of shares of CGP Cayman Island. Out of 10,000 crore of long term capital gain, what percentage of capital gain or what amount of capital gain is deemed to accrue or arise in India? To find it out, assessing officer in India will require some information, because this transaction would take place outside India. Indian AO will never come to know, so Hutch India will have to inform within 90 days from the end of the financial year in which the transaction has taken place. However, it's a big transaction, such a big transaction of such a large quantity which results into transfer of management rights of Indian company. If there is a transfer of say large quantity, more than 50% shares of CGP for example are transferred by Hutch Hong Kong to somebody, whereby the controlling rights of Hutch India, which were indirectly in the hands of Hutch Hong Kong, controlling rights or management rights are getting transferred to Vodafone UK or any other person, then it's a big transaction. Then time limit to inform or file that statement will be 90 days from the date of transaction. Otherwise, time limit is 90 days from the end of the financial year in which transaction has taken place. So, 90 days from the end of financial year, or it's a big transaction, such a big transaction which results into transfer of management rights or controlling rights of Hutch India, then time limit is 90 days from the date of transaction. If this statement is not furnished, there is a penalty. Penalty, in case the time limit is 90 days from the end of the financial year, penalty is 5 lakhs not furnished. And in case time limit is 90 days from the date of transaction for a big quantity transaction, then the penalty will be in terms of percentage, 2% of the value of such transaction. Not 2% of capital gain, not 2% of capital gain, 2% of the value of transaction. So, 271 GA, which is not that important. Failure to furnish information or document as required under section 285A by Indian concern, that is Hutch India. If the transaction has the effect of transferring management or control rights, that is a very big quantity is getting transferred, management or control rights in Indian concern, then penalty will be 2% of the value of such transaction. Otherwise, penalty will be 5 lakhs flat. 271 GB is slightly important. This is in connection with CBCR, country by country report. This also we discussed in this video called we discussed in this video called miscellaneous provisions, whereby every international group whose parent entity is resident in India, then like we had taken example of TCS group. TCS group is an international group, has presence in multiple countries, but parent entity is TCS India, they are resident of India. TCS India will have to furnish this CBCR, country by country report. Plus we'll have to furnish master file, local file also. Master file, local file we discuss separately. So, TCS India will have to furnish two things in India. They will have to furnish master file, local file as required under section 92D subsection 1 clause 2. It is to be furnished on or before the ROI due date, IT return due date. If not furnished, then there will be penalty. Penalty will be under section 271AA subsection 2. Penalty will be 5 lakhs flat. and they are required to furnish country by country report, which is required under section 286 subsection 2. Time limit to furnish this is 12 months from the end of the financial year, end of the accounting period, which is nothing but financial year. If there is a default in furnishing this, there is a penalty under section 271 GB. Penalty is in two layers. If the delay is up to 1 month, penalty will be 5,000 per day, and in case of the delay extends 1 month period beyond 1 month, then from next day onwards penalty will become 15,000 per day. Okay, so there are two different concepts. One is master file local file, for which separate penalty. One is CBCR, for which separate penalty. Master file local file we discussed in transfer pricing chapter itself, because it was governed by section 92D, which is a part of transfer pricing chapter. And CBCR we discussed separately in a chapter called miscellaneous provision, because it is not a part of transfer pricing chapter, though it is connected with transfer pricing chapter, but it is given separately in a separate chapter. So we discussed it at appropriate place. Penalty provisions for both of them are given in the same chapter. Failure to furnish report by reporting entity as required under section 286(2) in connection with international transaction. This is nothing but country by country report to be furnished within 12 months from the end of the accounting period. Then first 1 month delay 5,000 per day, beyond 1 month 15,000 per day. Now this 271 GB does not end here. This was subsection 1, then subsection 2 and subsection 3. Subsection 2 says that after furnishing this report, if the prescribed income tax authority, that is Joint Commissioner of Income Tax designated by Director General of Income Tax International Taxation, if Income Tax Authority requires any further documents or information to confirm the accuracy of the details given in CBCR, then that JCIT may issue notice giving some time limit to respond, generally 15 days. If assessee, that is TCS India, does not produce information and documents within the time allowed in this notice, then penalty will be 5,000 per day. Here only 5,000 per day, there is no concept of 15,000 per day. However, both of them, subsection 1, subsection 2, subsection 1 is for failure to furnish CBCR, and subsection 2 of 271 GB, subsection 2 is for failure to respond to the notice within the time limit. Both these defaults, whether penalty is 5,000, 15,000 per day and here 5,000 per day, both of them will become 50,000 per day. Both the penalties will become 50,000 per day once the penalty order is passed. Once the penalty order is, now I am not talking about show cause notice, I am talking about penalty order. After service of penalty order, if the default still continues, then penalty will be 50,000 per day. 271 GC newly introduced penalty for liaison offices of non-resident in India. Penalty for liaison office. According to section 285, every liaison office of non-resident or a foreign company in India will have to furnish one statement giving details of their activities in India during the entire financial year. This statement was to be furnished within 60 days from the end of the financial year, and there was no penalty, and the time limit was 60 days. AY 25-26, Nirmala Sitharamanji, she made two amendments. Number one, she changed the time limit. Time limit to furnish the statement, which was 60 days from the end of financial year, she made it, she changed it. She said now time limit will be specified or will be notified by central government. Up till now, as of today, no such time limit is introduced, but earlier time limit was 60 days, that has been deleted. Secondly, there was no penalty provision for this for default year. Now the penalty provisions are introduced. Penalty will be 1,000 rupee per day if the delay is up to 3 months, and beyond 3 months penalty will be flat rupees 1 lakh after 3 months of delay. So 3 months is around 91 days, whereby 1,000 per day would have been 91,000. Instead of that, next day onwards penalty will be flat 1 lakh rupee. Next is 271H, which is failure to furnish TDS TCS statement. TDS TCS statement, if you recollect, in TDS TCS chapter we have discussed it, that this statement to be furnished, quarterly statement to be furnished within some time limit. For TDS April, May, June, quarter ending April, May, June, first quarter, time limit is 31st July to furnish this statement. Next quarter, July, August, September, it will be 31st October and so on. Next month, 1 month after the end of the quarter, except of last quarter. For TCS chapter, the time limit is slightly less, slightly different. Instead of 1 month from the end of the quarter, it is 15 days from the end of the quarter. If not furnished, minimum 10,000, maximum 1 lakh rupee penalty can be levied. Here some small amendment is carried out, which I have not covered here because not required. Here amendment, earlier there was a exception out here. That exception was that the delay is not more than 1 year. No penalty if delay does not exceed 1 year. Now instead of 1 year, Nirmala Sitharamanji has drastically brought it down to 1 month. If the delay is up to 1 month, then no penalty, provided TDS amount is deposited along with fees and interest. TDS amount should be deposited, then statement is not furnished up to 1 month from the due date of filing statement, then no penalty will be levied. 271I again pertaining to TDS chapter. In TDS chapter, at the end we had discussed one section, section 195. 195 section applies when the payment is to be made to non-resident or a foreign company. Whosoever makes payment outside India, whosoever remits money outside India will have to furnish CS certificate in forms 15 CA and form 15 CB. Two forms are to be furnished. Those having practical experience must be knowing it. Failure to furnish that information in form 15 CA CB or furnishing inaccurate particulars will attract 1 lakh rupee of penalty. Remember, 1 lakh rupee is for each certificate and is not for, or each form 15 CA CB. It is not in totality. So your client has got 10 payments to 10 different people, and for which 10 different certificates were to be issued, then penalty can go up to 10 lakh rupees if not furnished. 271J, interesting penalty. Penalty on chartered accountant, merchant banker or register valuer. If chartered accountant specially has given any wrong information in the certificate or any report which is required under Income Tax Act or Income Tax rules, 3 people, CA, merchant banker or a register valuer, if any report or a certificate there is incorrect information in any report or any certificate which is required under this act or under rules thereafter, then 10,000 rupee for each such report or certificate penalty. Next is 271K. 271K we had discussed in charitable trust chapter and PGBP chapter also. Here if you recollect, in PGBP chapter there was section 35, donation or amount spent for scientific R&D. There were two concepts in section 35. If you recollect, we had discussed it in chart form: in-house research and contribution to third party, outsider. In-house research and third party contribution. If as far as third party contribution is concerned, whom can we contribute to? Meaning thereby we contribute from our business income to that eligible third party, approved under section 35. School, colleges, not school, but colleges, educational institution, IIT, etc. When we contribute to them, we get deduction from our PGBP income under section 35. Similarly, if you contribute to any charitable trust or public charitable or religious trust, you get deduction under section 80G, 50% of the amount donated or 50% of 10% of adjusted GTI. Deduction is allowed. So we get deduction under section 35 or under section 80G. There had been many reported cases of bogus donations and people claiming bogus deductions. So government came out with a new system from AY 20 to 23 that now these people who receive your donation, the donee, that is research association, university, college referred to in section 35, company referred to in 35(1)(2)(a), or the institution fund referred to, that is charitable institution or fund referred to in 80G subsection 5. These people, after receiving our donation, they will have to do two things. Number one, they will have to furnish statement in form number 10 BD to prescribe income tax authority and issue a receipt or a donation certificate of donation to the donor in form number 10 BE. No need to remember form numbers, as I told you earlier. If this is not done within the time limit for both of them is 31st May of the next year. 31st May of the next year. So April and May, 2 months from the end of the financial year. After the financial year is over, within 2 months, if this is not done, then there is a penalty. Penalty how much? Penalty will be minimum 10,000, maximum 1 lakh rupee. Failure to deliver statement or failure to furnish certificate to the donor by these people, and this penalty is in addition to fees under section 234G. 234G, which is 200 per day, and penalty can be avoided but fees cannot be avoided. This will definitely be attracted, you know about it. Okay, next is 272A subsection 1. This covers, it's a 10,000 rupee penalty with regards to summons under section 131(1). If you recollect search and seizure chapter, prior to that we had discussed one chapter called income tax authorities and their powers. Last section of that chapter, income tax authorities and their powers, section 131, where AO will not come to you, AO will call you, you come here along with certain documents, books of account, plus he can take your statement on oath. Whatever you answer, he will ask you questions, you have to answer on oath, then your signature will be taken that this is the statement made by you. If the person without reason refuses to or fails to answer any question put to him during interrogation, or after answering the question he fails to sign the statement without reason, or he fails to attend summons under section 131(1), or he fails to give evidence or fails to produce books of accounts in compliance with summons, 10,000 rupee penalty. Or this 271 subsection 272A subsection 1 clause D, which we discuss in assessment procedure chapter, failure to comply with the notice under 142(1), or notice for special audit under 142(2)A, or scrutiny assessment notice under 143(2), or direction under section 142(2)A for special audit or inventory valuation, then 10,000 rupee for each default. However, here 142(1), 142(2)A special audit and 143(2), these are not complied with, no, then apart from 10,000 rupee penalty for each default, in addition to that there can be best judgment assessment under section 144, which is also called as ex parte assessment. So if you recollect, this penalty we had discussed multiple times. We discussed this penalty once in 142(1), second time we discuss here, third time we discuss here, fourth time we discuss while discussing 144, and here we are discussing it for the fifth time. Okay, five times we discussed. By now you should be comfortable. Okay, next is 272A subsection 2, 500 rupee per day penalty. Here the penalty was 100 rupee per day, but recently 2-3 years back it was shot up to 5 times. 5-fold increase to 500 per day, 500 per day for certain defaults. For namesake there are 5 defaults, but actually they result into A, B, C, D, E, F, G, that is 7 different types of default. These defaults we discuss in respective chapters also at respective places, plus we discussed in penalty chapter. So quickly, failure to furnish requisite information in respect of securities as required under section 94(6). This has kind of become redundant. This was in connection with dividend stripping transaction and bonus stripping transaction. That chapter only has become redundant. That chapter was applicable only till the time some dividends from shares were exempt under 1034 section. Now you know pretty well, since past 3 years dividends are taxable. Dividend from shares of Indian company are taxable. Whether it is interim dividend or final dividend, dividends are taxable. There is a TDS also on dividend under section 194, 10% TDS. So when dividends were exempt, at that time there was some tax avoidance transactions possible. To cover that up, to plug that loophole, government had introduced section 94(7) and 94(8), and in connection with that 94(7) and 94(8), the income tax authority could ask you to furnish details of securities held by you at any time during the year under section 94(6). Within 21 days one had to furnish the information. If not furnished, then 500 rupee per day penalty. But that has become redundant for this first point. Second point is again unimportant. Second point, failure to give notice of discontinuation of business. If assessee carrying on business profession, as per 176 subsection 3, within 15 days from the date of discontinuation of business or profession, he has to inform the AO. Otherwise 500 rupee per day penalty from 16th day. I have never seen in my entire 25 years of career anybody imposed with this particular penalty, so it's unimportant and has never come in the exam also. Then C point is slightly important, failure to furnish in due time the returns or statements or certificates or deliver declaration or allow inspection under section 133. 133 is a requisition or kind of a summons whereby you can be asked to furnish details of third party. Okay, so in connection with third party's assessment proceeding, ongoing assessment, if you are being questioned, say you are a share sub broker, you are registered with Motilal Oswal. Motilal Oswal is a share broker. Motilal Oswal's assessment proceeding is going on. In connection with that, if questions are asked to you to cross verify certain thing and you do not reply within the time allowed, then 500 per day penalty on you. Section 134, power to inspect register of shareholders. Here notice can be issued to the company asking company to furnish the details of shareholders or debenture holders or mortgagees, if company, ideally private company, but it could be public company also, if company fails to furnish list of shareholders or debenture holder, then 500 rupee per day penalty. 139.4a IT written by trust. 139.4c IT written by certain institution associations whose incomes are exempt under various clauses of section 10. Research association like ISRO, news agency, okay, mutual fund, etc. 192.2c, 192.2c TDS on salary. Apart from TDS on salary covered by TDS certificate, apart from TDS certificate in form 16, the employer will have to issue to the employee a statement in form number 12BA within the same time limit. Form number 12BA giving the details of profit in lieu of salary and perquisites, along with a gross value, exempt amount and the net taxable value, along with bifurcation. Form 16 TDS certificate will contain only the final taxable amount. Bifurcation will have to be given in form number 12BA. Nowadays they call it as part 2 of the salary certificate, which is actually not part 2, it is form 12BA. Normally in real life, since past couple of years I am seeing that most of the employers are issuing form 16 and form 12BA together, and form 16 they call it as part 1 and 12BA they call it as part 2, which is nothing but form 12BA. If not furnished, then 500 rupee per day. Or 197A form 15G 15H. To avoid TDS, payee will furnish form 15G 15H, payee will furnish to payer requesting payer to not to deduct TDS. This form 15G 15H has to be in duplicate. One copy payer will retain with himself and one copy payer has to furnish to income tax department by 7th of the next month. If not furnished, 500 rupee per day penalty on the payer. 203, 206, 206C and 200 subsection 3 are all for in connection with TDS and TCS. Two of them are for TDS statement, quarterly statement and TDS certificate, and two of them are for TCS quarterly statement and TCS certificate. If not furnished, then 500 per day. And in connection with TDS, TCS, there is a relief given here that penalty pertaining to TDS, TCS should not exceed the amount of TDS. Penalty shall not exceed the amount of tax deductible or tax collectible. This, remember, this concept is only and only for TDS, TCS related penalty, not for any other penalty. Penalty amount can exceed the amount in default for any other thing except for TDS, TCS. Only for TDS, TCS penalty amount cannot exceed the amount in default. Recently, 2 days back, some ex-student of mine, he contacted me that, sir, here assessing officer has charged interest and the total amount of interest is exceeding the amount of tax. So, can they do this? I said, of course, here interest can exceed the amount of tax or amount in default, but penalty for TDS, TCS cannot exceed the amount of tax in default. Other penalties can exceed. Penalty, interest, everything can exceed the amount of tax or amount in default. Okay, in fact, the very first penalty 270A, if you recollect, 200% in case due to misreporting, then 200% of tax payable. So 200% of tax payable is automatically double of tax. It will exceed the tax. Okay, then failure to deliver or deduct and pay tax under section 226 subsection 2. 226 subsection 2 is a part of recovery proceeding chapter, whereby if I am the defaulter, then in my connection, if I am the defaulter and department comes to know that I have to recover 1 lakh rupee from Mr. X, I had given loan to Mr. X, then department can directly contact Mr. X and tell him not to pay 1 lakh to Nihit sir, but to deposit 1 lakh with government account. If Mr. X does not deposit, 500 rupee penalty to Mr. X per day. Then failure to deliver or cause to be delivered in due time, the declaration for non-collection of tax. Non-collection of tax in form number 27C, which is similar to form 15G, 15H for TDS, here for TCS we have form 27C. One copy, it will be in duplicate, buyer will furnish to the seller, seller will retain one copy out of duplicate, one copy seller has to furnish to income tax department by 7th of the next month. If not furnished, then 500 rupee per day penalty to the seller. Then failure to deliver or cause to be delivered, a copy of statement within the time limit given in 200 subsection 3 or 206C3. Again, it is in connection with TDS, TCS, shall not exceed the amount in default. And last one, failure to deliver or cause to be delivered, quarterly return within the time limit given in 206A subsection 1. Again, connection with TDS, TCS. 206A is in connection with TDS, but it is this particular penalty is no more applicable with regards to TDS TCS, because for TDS TCS we have penalty under section 234E, which is 200 rupee per day, 200 per day. Because of this fees, it is fees under 234E. Because of that, penalty of 500 rupee will not be levied. 272AA, failure to comply with 133B, door-to-door survey, where income tax authority will come with a questionnaire in form number 45D, where there will be 13 pre-printed questions. It is unimportant from exam perspective. We discussed it in search and seizure chapter. Maximum 1000 rupee. It says penalty not exceeding 1000 rupee. Next is 272B, slightly important. 10,000 rupee for each default. This is in connection with permanent account number, and the same penalty 272BB with regards to tax deduction account number. Penalty for PAN number, 4 types of default. Number 1, failure to apply. Person who is required to apply as per section 139A does not apply for the PAN number, or after obtaining he does not quote the PAN number, or alternatively Aadhaar number. Aadhaar and PAN number can be interchanged, you know pretty well, if it is linked on the income tax portal. In transactions, wherever required, the PAN number is required to be quoted. In rule 114B, there are 18 transactions where PAN number is required to be quoted. If wherever required, after obtaining PAN number does not quote wherever required, like while opening bank account, while opening demat account, while buying selling immovable property, while buying selling four-wheeler, while transacting in cash for restaurant bill or travel outside India, paying more than 50,000 in cash, then PAN number is required. If not quoted, then penalty. Or quoting a false number, false PAN number or false Aadhaar number, knowing it to be false, purposely with a malified intention. If the wrong number is given, then 10,000 rupee penalty for each default. And last one, the person furnishing his Aadhaar number, he is not only required to furnish, plus if he is furnishing to bank for prescribed transactions, if he is furnishing it to bank, then bank will ensure that bank not only obtains his Aadhaar number, but bank will also get it authenticated. What is authentication? So authentication can be done either using biometrics, by in some machine the assessee will have to give his thumb impression, or will have to allow his eye retina's picture to be clicked, or assessee will have to furnish OTP coming on his mobile phone, registered mobile phone linked with Aadhaar number. Assessee will have to get it authenticated, bank will have to get it authenticated, and assessee will have to cooperate with the bank, will have to share OTP, or will have to give his thumbprint, or will have to allow the bank to click his eye retina picture. If assessee does not do that, then 10,000 penalty for each default on the assessee. On the other hand, 272B also imposes the same 10,000 penalty on the bank if bank does not ensure this. Failure to ensure that PAN number, Aadhaar number is duly quoted and duly authenticated in respect of transactions referred to in 139A subsection 6A. 139A subsection 6A read with rule 114BA. There are 3 transactions: depositing or withdrawing, depositing 20 lakhs or more than 20 lakhs in any savings account or current account, withdrawing 20 lakhs or more in cash in any from any savings account, current account, FD account, RD account, any account. And while opening CCOD account, cash credit overdraft account, then bank will have to follow this procedure. Last one, 272BB, same default with regards to tax deduction and collection account number, also called as TAN number in brief. Failure to comply with 203A section. Now 203A does not apply to 3 types of TDS transaction, does not apply to 194IA, 194IB and 194M. Barring these 3 exceptions, which we discussed in TDS TCS chapter also, barring these 3, person who is required to deduct the tax at source under any section, or the person who is required to collect the tax at source under any subsection of section 206C will have to first apply for his TAN number. Failure to apply wherever required, or failure to quote, failure to comply with 203A section, that means failure to apply, or after obtaining failure to quote in the returns, statements, challans, everywhere, or any communication pertaining to TDS TCS, or quoting false number, or which he does not believe to be true, or he believes to be untrue, then 10,000 penalty. Simply quoting false number knowing it to be false will be 10,000 penalty. Then in TDS, in penalty chapter, after penalty was over, we had discussed section 273A subsection 1 and subsection 4, immunity from penalty. Once a penalty is imposed, one can approach CIT, PCIT. CIT, PCIT has a power, if some conditions are fulfilled, then they have a power to either reduce the penalty or waive off the penalty if certain conditions are fulfilled. There were 3 conditions in 273A1 and 2 conditions in 273A4 which were important, but theory question can come, practical not possible. Theory questions pertaining to this were asked long back. Last they were asked somewhere in 96-97. Thereafter questions haven't come. You can treat them as little unimportant. Ideally, common condition is that assessee should have cooperated with the department. 273A1 is possible only for penalty under 270A, and 273A4 is possible for any penalty including 270A. Then 273B is slightly important, saying that no penalty if there is a reasonable cause for the default. If there is a reasonable cause, assessee has a justifiable reason for the failure or default, then penalty will not be levied under any section except of, out of 31 penalties, this benefit is available for all section except of penalty under 270A and 271AAB. This is underreporting of income penalty, and this is again same penalty, concealment of income, but for 7th year of search and maybe immediately preceding year, 6th year. This concealment penalty or underreporting penalty will always be levied irrespective of whether there was a reasonable cause or not. Government believes that there cannot be any reasonable cause, there cannot be any cause which can be reasonable for the purpose of evading tax. 274 show cause notice for penalty. I told you penalty proceedings are totally different than the assessment proceeding. For assessment proceeding, AO will have to issue notice separately, pass order separately, and can be appealed against separately. Same way for penalty proceeding, AO will have to issue notice separately, will have to pass penalty order separately, and will be appealable separately. So before levying penalty, AO will have to issue a show cause notice, and 275 is the time limit to pass penalty order. 275 subsection 1 is for time limit to pass normal penalty order. 275A subsection 1A is time limit to pass rectified penalty order. Time limit ideally is 6 months. 6 months from the end of the month in which so and so happens. There were 4 possibilities in normal time limit. Time limits are not that important. Questions pertaining to time limit to pass penalty order were asked long back. You can refer to the main notes where I have given example also. That's it. With that, the revision of penalty chapter comes to an end. See you in the next video with some other chapter. Till then, wish you all a very good luck. All the best. Take care.